Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, September 28th, 2023. It's 10:36 a.m. Eastern Times. I'm starting the video, so we're about an hour into the trading day, and I just want to go over both key levels to watch and also try to impress what I believe the importance of being flexible and not staying married to any one positioning or bias, especially right now where we're at. And that's the whole point of this video. I'm going to show you just some key levels where we're at, and just again reiterate that this market's probably going to break either way from here. We're either going to see we have the potential to see a decent rally. Yeah, I gave you some near-term targets, bounce targets, and also very much the downside potential. Nothing's changed on my intermediate to longer term outlook. I still think we're going a lot lower. You still have these longer term swing trend targets. Some of you may be short now, may have been short off the highs or anywhere in between, and still targeting these. And these could get hit. So as I showed you in that video the other day, I took a clip from that movie Heat, where Robert De Niro's character says, "Don't let yourself get attached to anything you are not willing to walk out on in 30 seconds flat if you feel the heat around the corner." That is and always has been my drive-in mantra in trading and investment, at least for a long time. And I'll tell you, early on, like everybody, you tend to, at some point, most traders tend to get married to certain positions. There's one trade you just love at one point in time or another, whether it's a stock or where you think the markets are going. In some cases, the fundamentals are screaming buy or sell, and the technicals are confirming as well. Those are usually the best trades when the technicals and the fundamentals align, technicals being the charts. But the takeaway is, do this long enough, and you're gonna find out that even the best looking trades don't always pan out, and quite often when they don't, they can really go the other way, and that's where And again, I'm just this site is almost like a blog or a diary. I do what I love, and I get out here and I do it, and I'm doing it for a living. But I like to share, and I can tell you, I've had in the past, just one or two bad trades, that I just stubbornly held on to and didn't use hard stops or ignore my trading plan. Those can wipe out, months of gains, and sometimes maybe even a year of gains, if it's a big enough trade. So position sizing always, spread your eggs around. Don't put all your eggs in one basket. Don't put too much in any one position. And don't fall in love with any trade. That's the key thing. So, I just, again, going off on a little tangent here, but I'm a pretty flexible trader, early on, when over the years, I've seen a lot of people's trading rules, and one is always have a trading plan. Stick with that plan. Don't change it. I will modify my trading plan. And that's, again, goes back to that quote I just gave you, where if at some point in the trade I see something that convinces me, price action or something in the charts, that, hey, you know what, for example, this short trade recently, you might want to pull the plug in reverse. That's what I did yesterday, as I told you. Added to those positions today, and again, I'm going to go over levels right now. And so the takeaway is, I think we're going to break either way. There is certainly the potential for this market to just break down. There's still a lot of yellow flags out there, some even becoming red flags. So California muni bonds are still down today. I'll maybe get to that in a second. Something, I maintained it all along before the big banks, the three big banks failed early this year, the regionals. I and some others said something's going to break, and I still think those were the early things to break. More things will break, and the point is, we can do the henny penny, chicken little, sky is falling thing all day long, and the sky, I think, sooner than later will start to fall. It could fall literally today. You could take out today's lows and smash on down through there, or it could be weeks or even months from now. So I have not eliminated this scenario. Yes, the odds have ticked down recently, but it's still very much my alternative scenario. And of course, I gave you some near-term bounce targets today. Let's just review that, and I'll get to the levels. So here's QQQ. I think this chart said everything I got out to this morning. Divergent low on the 60-minute chart. The NASDAQ 100 here, QQQ, right back to that key August 18th reaction low after a brief undercut. So here's kind of my near-term analysis for you, and it plays into the intermediate term. I posted this chart under the post I got out to you this morning, the first post shortly after I posted this one right around 10 o'clock today, in the comment section of that post. And so what this is, it's a 5-minute chart, and I said here, solid breaks above each of these initial resistance levels on QQQ would help to firm up the case for a more significant rally. So, and these are also objective levels to add. So let me move that down. Let me go to a 5-minute chart. That's what this video is all about, giving you levels that are just going to increase the odds that we could get that tradable bounce scenario. And the tradable bounce could be pretty significant. Again, I'll show you why in this video. So this is the first one here, and that is 356.75, give or take, right there. I think if we can pop that, you can see QQQ, it's been capping that level. It was support back here, and we broke it. So that should spike us up and help, increase the odds of more upside today. And more upside today will also increase the odds of more upside in the next week or so. And of course, next level here, 359.69. So that's how I had it drawn on there. Breakout 1, breakout 2. So if you don't know what to do, because I'm making your heads, my analysis, 2 days ago I was bearish and short and planning and telling you I was going to sit tight on those swing shorts. And then yesterday I told you I covered them all. And when actually, reversed into long, I still have a couple individual stocks short, but I've covered quite a bit. I think time to, yesterday home builders hit one of the targets, so covered those. And I'll get to some of the individual stocks in another video. But these are the levels to watch, guys. And again, you can reference that under the last post. You can get this chart and see those levels if you want. And then you can see over here, there's a big, huge volume and price histogram bars right there, and a gap right here. So you don't have any volume and price histogram bars. So there's a gap, and that is also the gap that I gave you on the 60-minute chart this morning with those bounce targets. So there's the gap right there. I believe that's the same gap. Yeah, it should be. A gap right here. Traders will look at the bottom, the bottom of the gap as resistance and the top of the gap. So the way it works is that's a logical target, first target, bottom of that zone. It's a relatively tight range, so I call it a T1 target zone. And the way it works is often if you enter the gap, you're going to go backfill it, and that'd be your next resistance level. Then I have minor price resistance there at about 366.80 or so, and then about 372, and then the downtrend line. So I put the little asterisk that says T3, if we get up there, will be the first of the downtrend line, because the way it works, we're not going to get there today. Trend lines are dynamic, meaning they come in at different price levels every day due to a positive or negative slope. So, go something like this, go up, hit the gap, maybe get a reaction there, and then work our way up here. And it should come in around together. And if that happens, again, this is why I like to do these videos, it's going to help firm up things on the 60-minute and daily charts. So this is why I always say all these time frames, to me, they come together. I don't trade them or treat them independently. If this, third target's hit, then guess what it's going to do on the, the daily chart? We're going to, number one, we'll have clearly had this prove to be a little fake out. Remember I told you yesterday that I'd actually prefer and expect to see an undercut of T1, those August 18th lows. And so that's why I certainly didn't add to shorts. In fact, I did the opposite, expecting this will probably, prove to be, and it is, it's a divergent low, positive divergence. Let's not forget about the big market leaders. I'll get to those in a second. But so if we get this, then it's going to confirm the divergence on QQQ and some other stocks as well, and set the stage. There's that gap right there, and then the downtrend line, which at this point in time is my current, final target there. Now my point is, if it happens, and it happens soon, we reverse here, we're going to have that recovery. There will clearly be a bear trap, that breakdown yesterday, and those shorts that piled in, what I call JCL or Johnny Come Lately shorts. They didn't want to short here on this breakdown that was highlighted, or this one, or the pushback to 381, or that sell signal right there on the primary trend line break. They wanted to short here, and it's become clear. And, I get it. It's just I have a different trading style. I try to get ahead of things, and I get it. We have all the makings. Being that we undercut the August 18th low yesterday, firms up or solidifies the case we're now in a downtrend, because a downtrend is simply defined as a security making lower highs and lower lows, and that's what we had so far. And so now that makes it official and really clear, if you will, to to the masses that for the last 2.3 months the stock market now is in a downtrend. So why didn't I add to my shorts, and why did I cover again? For all the reasons I've talked about here. So let me just get to the levels, and again, how if we get the lift here, and it all starts with that little 5-minute chart. You pop each of those levels, you go up, and it is going to further solidify or give me check marks for my near-term bullish case now. And so that's where I turn my focus back over here. And I gave you a stop. I told you it's suggested. You can do what you want, but we really, at this point, you would still have a divergent low if it's taken out. So I'll tell you this right now. Maybe they run the stop, my stop, I get out of those long positions, but then they turn around and reverse it, and then you have the whipsaw or the bear trap in play. Then I could get back into those longs. Not a big deal there. Okay, let's look at the other indexes. QQQ. I've covered that one quite a bit recently. Let's look at SPY, and then I want to show you VTI, which is the Vanguard. It's a very well diversified ETF, stock equity ETF, and it's probably the closest thing to, they call it, I think, the total stock market index fund or whatever. It is probably the most accurate, right there with the Wilshire 5000, because remember, the NASDAQ 100, it's a great trading vehicle, but it is far, far, far from a diversified index or anything remotely representative of the U.S. economy. It does not hold any financial stocks, very little utilities and things like that. It holds mostly, the majority is over 50% tech stocks. So that's where you get all the juice. It's going to follow the S&P 500. It's just going to outperform to the upside in a bull run and drop more in a downtrend, typically. All right. So the S&P 500, much more diversified and representative of the U.S. economy, if you will. But then again, it's only mega cap, super large cap stocks. There are many, many times more mid and small cap stocks. So it's far from a total, accurate representation of the entire stock market. But with that being said, it's what a lot of folks watch, and the large caps do matter. Those are your, most liquid companies, most actively traded, most followed by analysts. So if there's anything going on with one company that's running up, some analyst somewhere, some hedge fund's going to find some reason and uncover any problems there. So, you tend to have more visibility and less surprises, if you will, with large caps. So a lot on this chart, busy chart. But, we started out here, and again, all this was highlighted at the time. We had a bearish rising wedge with a sell signal right here. That followed that bearish engulfing candlestick and divergent high. So that was check. About as good multiple sell signals there in short order. Went on to then break below the secondary trend line right there. Perfect breakdown and back test. And then we recently broke we broke that longer primary trend line off the mid-October lows. And so this is why I'm again, I'm driving with one foot on the accelerator and one just above the brake, and I'm ready to flip back short if need be, because we've broken the trend line off that lows. Although it wasn't a great trend line, it was the one off the October lows, but there were only a couple distinct reactions there. Turn off all the lines. We hit and fell to the key 200-day exponential moving average, and for the last 3 days, the SPY has held that level, It even had an intraday break in a recovery. So what happens there, again, that's a little bit of a bear trap. You get the short seller say, oh, the 200's gone, I'm going to short it. And guess what? We're parked back above it. So as I like to say, support is support until less broken. And we're still holding the 200-day exponential moving average. Sometimes it's the 200 simple down here that'll do the trick. And sometimes it's the exponential. But and the other thing too, when trading on or analyzing a daily time frame or trading off it, all that matters is how you get the closing candle. That's why you want to not act on intraday breaks, rather solid closes below or above resistance support levels. And then I know there's a lot here. Your head might be spinning. So among everything else I've seen, I highlighted this potential head and shoulders pattern here. That's your LS. It's in purple. All the purple lines: left shoulder, head, and a right shoulder, and this purple line right here is your neckline. So that's broken down. This is the measured target for the head and shoulders pattern right here. It goes down to about 410 or so. That's the widest part of the pattern from the top of the head down to the neckline. That's what I've done there. So I can sit here and this is what I'm doing to you. I'm making a bearish case, I'm making a bullish case, and I'm telling you at the end of the day how I'm positioning and you know, how I'm ready to flip back if this bounce and the buyers don't step in here where they should, again, quote unquote should, I put that in parentheses. Let's go to VTI and then I'll cover the market leading stocks and we'll wrap the video up. Okay, VTI, as I mentioned, that's the Vanguard Total Stock Market ETF. Once read article and put this in my watch list a while back that it's very, again, just very well diversified. You can read up on it. So it's more accurate of what's the stock market doing, not just what are the large caps doing, because at any time sometimes you have the small caps getting pounded while the large caps are doing well, or vice versa. So this is a guide, and if you can look at an index or an ETF like this that is more representative of the stock market, it does give you the bigger picture. So let me tell you what I see here. Number one, we have a trend line off the October lows right there, like S&P, and we are below it, but by the slightest of margins. In fact, I'm going to zoom in for you. You can see 209.57 before I zoom in. Why is that level there? Numerous reactions. It was resistance, resistance, pop, breakout. Breakout, once resistance is broken, it becomes support. You had multiple tests there, successful tests, support, support, support. Support, volatility was picking up, so we were cutting through there a little bit, but once it was clear that that level gave way, boom, big drop, rally back, traded on it for a few days, couldn't get through it, boom, big rejection. So there was a false breakout, but that also came into play with the downtrend line. This is why I have all these lines. This is why my charts sometimes look busy, because some eyes saw this and went long, and other eyes saw this and said, oh, no, I'm going to short that rally into the downtrend line and the 200-day moving average. There's the blue line was a perfect rejection, as it was with the S&P 500 right there. If you can see it, the blue line, which is the 200-day. And I'm going to get to that in 1 second. Multiple other rejections on both the downtrend line and the 200s, just like SPY. They came in together. And then finally a breakout. Little whipsaw down through there. But once the 200s were recovered, and then boom, once that level was recovered, you got that nice big rally. And we're right back there. This is what I wanted to highlight. So we hit that yesterday. So this correction, or drop from the top, whatever you want to call it, so far has taken us down to a confluence of key support levels. The uptrend line off the October lows, and big, probably the biggest horizontal price support level on this whole chart over the last couple of years, in my opinion, because it has the most reactions and how, not just the number of reactions, but also how it acted. Once you popped it, boom, off to the races. So this is the first back test of that level since we broke out right here. Again, you have the 200, the red line's the exponential, and the blue line's the simple. So you have those two key moving averages. So this whole area here is a confluence of very good support. If it goes, and it goes with conviction, that's nothing but bearish. I don't have positive divergence on the daily chart of VTI, so I don't think we're going to go to new highs. That's my guess. but we could get again a reflexive bounce. This is where the buyers will typically step in. And if they don't, let me say this, if we just slice through there like a hot knife through butter, which is kind of what we did back here when we rolled over off the highs, off the divergent high, we took out the 200s. And it was like Monopoly, go to jail, do not pass go, do not collect 200. We just went down through there, and then we back tested them, and that was it. And it just kept capping. So it is possible we just go right on through there. And that's, again, my whole don't let yourself get attached to anything you're not willing to walk away from in 30 seconds if you feel the heat. So that's, hopefully you now know my mindset. I'm ready to react, adjust accordingly, but there's just a whole confluence of support. It's the biggest correction we've had in months. The VTI, which will be in line roughly with SPY, is down about 8.5%. And now let's get to the big market leaders. I'm going through the watch list or the holdings of VTI, and they're going to look just like QQQ and SPY. And I'm going in order of market cap. You can't see the watch list. It's just off to the right of the screen here that I'm recording. So you have Apple. Apple, of course, probably, without a doubt, the most important one, but it's not everything. 200-day simple moving average, 200 exponential, positive divergence on Apple. You can see the indicators making higher lows against price making lower lows. And last time we had positive divergence on the daily chart of Apple was right here in the beginning of January. And yes, we were long. It was listed as my favorite stock, overweighted. Apple and Amazon listed as my two favorites, and I think Tesla maybe. In the time before that, we had positive divergence, and the daily was right there. So for me to ignore that and just whitewash it away and say, what, we're going, that's just not, it's just, I wouldn't be doing my job. And so there it is. So there's one reason to be long, and a reason that says again that we could have a more than just a little bounce trade. Let me give you another target on Apple. I think I gave you that as a breakdown level the other day, about 173.65. Look, I'll say this: if you agree with my analysis, right now I wouldn't even be concerned about upside price targets. I know that's not a typical trading plan. I always have a plan what you're going to buy, where you're going to sell it, and where you're going to stop out of wrong. I would just more be concerned with, does the bottom fall out? Do we go and undercut these 200-day moving averages, especially on a daily close? We might have to give it a little bit of room because we could have one more thrust down. But again, there's just a mountain of support here. Oh, before I get to the other ones, and I'll wrap the video up, let me just go back to VTI and show you something else I didn't do. All right, here is the weekly chart. This is my weekly of VTI. This is, these are the divergent highs right here, 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 and here. All right, so you can see what happened. That was the last real bear market, in my opinion, October of 07 to March of 09, 55-ish% drop in both the S&P and the NASDAQ. Second drop was here, fourth quarter, or that was 2015 into 2016 there, roughly. You had a divergent high here. I don't have it marked, but that was a Q4 of the big Q4 of 2018 drop, and that divergence got even larger into COVID, as I've said many times over. Although COVID will go down on the records as a black swan event, something that I and others couldn't have predicted, the drop in the stock market was fully priced in with the big negative divergences, sell signals we had. We were short at the, into that and down through most of that, based solely on technicals, because the technicals were reflecting that was coming. Whether you want to call it a coincidence or not, that's we can debate that all day. Divergent high here, right at the beginning of 2022, and that was, again, what I view as the first leg down in a bear market that will eventually go. And so here's the takeaway, guys. This is I have parallel trend lines. This one I have a lot of reactions on, and so I think it's valid. And then I have this alternative, and I just created a parallel trend line to that because you have these two spike lows, towards the end of the bear market. You had that final puke off, trying to capitulation drop into the 09 lows, and same thing, COVID was fast and furious, big reversal just like back then. But those are two key reaction lows. So where I'm going is, no trend line lasts forever. This has been a big, long, powerful bull market. I consider right now where we're at. And this whole thing, just one bull market. I do think we'll be in a bear market. I don't consider 2022 a bear market, although on the record books it went down over 20%. But you know me, that's an old antiquated number. Somebody came up with a long time ago. It might have worked at some point in the past in the Dow, but a bear market is, you'll know when you see it, and that's where I think we're going. But we need to break this trend line right here, and then it'll take us down to the next one. We'll probably get something similar like that. Now, let's turn off all these lines for a second. This is what I wanted to show you. Those beautiful little things I call the 200-day moving averages. On a weekly chart, since there's 5 days in a week, you'd need to make it a 40-period exponential. It's the same exact thing as your 200-day. 40 times 5 equals 200. So on my weekly chart here, these are the 40-week moving averages, or aka the 200-day moving averages, and they just do a beautiful job of defining the trend. By that, we can go back, let's go back to 2008. Okay, so during an uptrend, you want to buy pullbacks to those levels, and occasionally they'll get clipped on a day or week, but you can see how well they acted as support on the way up. Clearly taken out about at this point, right after the market rolled over at the end of 2007, that's early '08. Once it became clear and you got clearly away from those, and we're talking multiple weeks, multiple red candles below, then you're in a bear market. And then you short rallies back to it. Just like it acts as support in a bull market, those levels act, and you got rejected there. That second rejection sent you down. That was the big drop into the 2009 lows. And then look what happened right here. You recovered them. And from there, yep, they're not perfect. You had a couple whipsaws down through there, and even if you took it on face value, if you zoom in close, if you got out, you would have sidestepped months of sideways to down action. But for the most part, once the trend becomes established, there was a lot of volatility post 2009 financial crisis, everything, and then the market normalized, and you had that a couple times where you took them out, and that was a bear market. We went down to sideways. Several indexes dropped just over 20%. Some were just under, and that was 2015, 2016. There's the big Q4 of 2018 drop. Again, some indexes exceeded the 20% traditional bear market threshold. Others were right around there. So it's not as if that was a whipsaw. It was accurate. And then you got above them. COVID, you were down below. And since, zoom in, I know sometimes forget some of you are watching this on a cell phone. That's it. So after COVID, we took back the 200s there. We remained above them until the beginning of, was actually November of 2021. This is when the NASDAQ peaked. And then we took them out, as I showed you, back test. They acted as resistance. And then you recovered them here. Okay, I know I'm spending a lot, but that's it. So we're back down to those levels now. And so when tested from above, they typically act as support. But again, sometimes you bounce and sometimes you go down through them. So this is what I'm looking for. A week from now, 2 weeks from now, the end of this week, something crazy happened tomorrow and we had a big drop and we closed down here. I'd say, hey, the 200s are taken out. Now you want to short rallies back to them. Okay, and to take this video home, I already covered Apple pretty much in detail. We have Microsoft, second largest component right there. Big support at about 311.50. You slightly undercut the August 18th low, but you're right there, and you put in, or you have potential positive divergence. Again, potential. You look at the indicators, I don't need to see this PPO turn up. So we're at a very important juncture, I believe, where these divergences, this market can just crap out, take out the support levels below. Microsoft, other than the 200-day moving averages, my next price support is 293.60. And then ultimately, I think it comes back to this trend line here. And if these divergences get taken out, and some have already, you have a slightly lower low here on the RSI. So I'm very, very, very much not married to my current long positions. It may flip back quickly. But if we can pop it here, if the buyers step in where they usually do on pullbacks to these support levels, there's that downtrend line I gave you on Microsoft. We could pop that, get clearly back above this level here, this August 18th lows, then it's probably going to spark a short covering rally. And if we don't, then guess what? There was a lot of hot air in this rally off the lows, and things could get ugly, and they could get ugly fast. So again, key takeaway is stay nimble, stay flexible. If you don't know what to do, if I'm making your head spin because I'm talking about 1,000 different levels and moving averages and potential developments, and you're unsure, there's nothing wrong with being in cash. Watch, learn, put your money in a money market fund, earn 5.5% right now, and wait till you feel more comfortable engaging this market. To me, as a trader, this is where the money's made. The volatility is high. The VIX has been moving up. And this is when the market tends to make its big moves. This is frustrating. When you're in these trading ranges, nobody makes money, bulls nor bears. You can flip, if you're a 5-minute chart, you can flip the futures. That's what I like to do. Or trade individual stocks when the market's, going sideways, or sectors, whatever looks better. But recently, we're on the fresh off the heels of this breakdown, a lot of these breakdowns, bearish rising wedge and alphabet. And again, the thing about this bounce is this breakdown just happened, and it does not look to be over to me. So I think we maybe get a counter trend rally, ride that game. That's my current plan, and then get back short again and for the next leg down. Because there's a lot, excuse me, I'm a little hoarse today. There's a lot of stocks that have yet to even come down and test the 200-day moving averages. So there's Amazon right off the 200-day, very close. So you have some that are there in close proximity, others that are still well above. And those are the things that I'm watching, guys. So I'm going to just loop back to that 5-minute, wrap it up here, and then I'll get, like I said, I'll either follow up with some individual screenshots, some charts of the other things, crude oil, natural gas, wheat, commodities, all those other things I usually cover. But right now, this is where I'm hyper focused, and I think the opportunities are there. It's nice to trade the indexes when there's volatility, because the thing about the indexes, unlike individual stocks, you never have to worry about waking up to some crazy headline. There was some buyout on a stock you're short and the damn thing shoots up 20%, or earnings and you're paying attention. The earnings came out and there's a huge gap down. You don't have that with the indexes. They can gap down, but usually to the extent of 2, maybe 3% on a bad day. So because it's safety in numbers, whole diversification thing. So I'm going to leave it here. This is that level I want to see popped, and I expect to see pop today. That should take us up to there-ish, and then here, and then that's that big old gap right here. So that's where you'll likely, if we can get there soon, probably see some profit taking. Alrighty, this has been Randy Finney with Right Side of the Chart.